Here's an idea on how to manage a position. We are long December 11th, 20 calls in ticker symbol SPCE, Virgin Galactic. Yesterday we got into this trade. We picked up December 11th, 20 calls, paid $1.75. Today with the stock up about 50 cents, it's currently trading at $29.39. These 20 calls are currently going for about $2.28. As we can see, they're showing about a 30% return on risk. So one idea here we can, so if we paid $1.75, we can go and look to sell something for $1.75 and completely remove risk of this trade. So one idea would be to sell to open a 21 call. This will convert this position into a 2021 call debit spread, except we don't have a debit because we paid $1.75 for the 20 call, and now we are collecting $1.81 for the 21 call. We end up actually with a net credit for this spread. So worst case, this trade is going to make us about $8 if the stock is below 20 on expiration. And the best case, we have a 1-point spread for about an $8 credit. So best case, we'll make 108. Worst case, we'll make just $8. That's one idea. Another idea here, we can sell to open 2 of the 22 calls, right? So now we're long 20, we're short 22s, that's 2 points. And then we can buy the 24, one of those. This will convert into a risk-free call butterfly. So we're long 20 call, we're short 22s, and we are long 24. So this would be a 2-point wide call butterfly. Also, we would have no risk on the upside or on the downside. Best case scenario, stock pins 22 over the next 24 days. It's very unlikely, but if we do have price hang out somewhere between 21.5 and 22.5, say about 20 days from now, we can see what that will look like. So we can go 20 days into the future, so to speak. So if the stock's at 22, 20 days from now, assuming everything being volatility, everything else being equal, this trade is going to show about a $100 profit per one lot with no risk on the upside or on the downside. Now, if the price overshoots our butterfly and say over the next 22 days, the price is somewhere above 25, obviously it's still going to be a profitable trade. But the best for this trade is for the price to be somewhere inside of this tent. So if you think that we're going to consolidate sideways, or if we're going to trade in some kind of a range between 20 and 24, I think this is a very good way to remove risk of this trade and give yourself room for more upside, so to speak. One other idea would be to maybe sell a 24 if you think 24 is a near-term resistance, and then we can buy a 26, right? So this will reduce a little bit of risk in this trade. Will leave a lot of room to the upside, but as we can see that it'll start to reduce risk. And then as it continues to go higher, we can continue to sell more and more of these 24, 26 call spreads, and eventually end up in another situation where we have no risk on the downside. We're giving up some of the upside here between 24 and 26, but if the stock completely explodes and goes over 30, we still get to participate on the upside above $26 per share. So those are just some ideas. Not that we have to go out and do anything right this minute, but it's always good to think about ways to remove risk of this trade. I hope you find this useful. I'll talk to you next time.